In this video, we'll review several ratios that, from a common sense perspective, tell us that higher highs are likely before year end. They also tell us that a major peak in risk assets does not appear to be imminent. In this video, we compare numerous risk-on to risk-off ratios. We'll look at the spring peak in April-May of this year, compare it to the present day. If you look at these charts with an open mind, I think you'll agree that higher highs are most likely before the end of the year, even if we get some type of short-term pullback. It's important that we keep an open mind as we're reviewing the charts. Currently, we have some yellow flags on the charts, but there's nothing in the red flag area that says a significant reversal is imminent. Since charts can change quickly, we'll be posting updates during the week on Twitter. You can find us by Googling @Shavaco Capital. If you find these videos useful, we really appreciate retweets. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Like many of the things we review in these videos, this looks complex and noisy. It's very easy to understand if we walk through each piece in isolation. What we're looking at here on the left, this is the S&P 500. This is the peaking process last spring. This point here is early May, where the S&P 500 really began to roll over. So you don't want your present day market to look like this point here. On the right side, we have the present day. This is the S&P 500 at the top. This is the closing price on Friday, October 5th. What we'll be comparing here is the New York Stock Exchange Advanced Decline Line, which is a measure of market breadth. What it is you take the number of advancing issues on the NYSE and you subtract the number of declining issues. A healthy market has broad participation. A weak market tends to have narrow or narrowing participation. So what we have here, peaking process. This is what the NYSE Advanced Decline Line looks like. You can see here it basically went sideways from early March of 2012 to the point where the stock market peaked and really rolled over after May 1st, 2012. This is concerning. This is market breadth that's not making higher highs or picking up steam. The advanced decline line today, and notice we're comparing the same window. Here's 1 month, 2 months, and roughly 5 days. 1 month, 2 months, and roughly 5 days. The advanced decline line here obviously looks much healthier than it does here. These are 2-hour charts that we're looking at. Why are we looking at 2-hour charts? We're trying to see small differences, get an early read on what a market looks like when it peaks and rolls over. On Friday, on the 2-hour chart, the advanced decline line made another clear higher high relative to this high. You can even argue this is the S&P 500. It's going sideways here. This is actually a bullish divergence. Breadth is making a clear higher high while the market went sideways. This looks good. This doesn't look so good. Now we will compare the indicators. This is Williams %R for the advanced decline line. What do the indicators look like when a market's rolling over, and what do they look like today? So let's scroll down here a little bit. Scroll down here. Get these lined up. Here's what the peaking process looked like when the market rolled over, Williams %R, which is a measure of momentum. So we're looking at momentum here for the advanced decline line or market breadth. This is weak. This is one of those skinny peaks that we spoke of in the last video. Compare this to the last few days here. This looks good. This is positive conviction behind market breadth. RSI As the market peaked, RSI made a lower high, rolled over and looked weak. Here the trend is positive and well above 70 with bullish conviction. MACD, the short-term trend for the last 7 to 8 trading days when the market rolled over, didn't look good. Compare that to the last few trading days that we've had in the present day, looks pretty healthy. MACD histogram, we're going from a high to a low. In the present day, we're going from a low to a high. This looks quite a bit better than this. Rate of change, this is where the market rolls over. Rate of change going from a high to a low. And here we have an uptrend in place. This high here is higher than this previous peak here, which is positive. Net bottom line on this chart is market breadth tells us that even if we experience a short-term correction, we probably have not seen the highest highs in the current rally. This looks healthy. This didn't look healthy. For the next series of charts that we'll look at, the concepts will be the same. Here, this is where the stock market, the S&P 500 on a 2-hour chart, rolled over. This is early May of 2012. Here is where you wanted to get out or short or go defensive. Here we're comparing the S&P 500 ETF SPY to SH. So we're looking at longs relative to shorts. When the ratio here is rising, longs are outperforming shorts. When the ratio is falling, you'd prefer to be on the short side of the market. Here again, we're looking at 1 month, 2 months, and roughly 5 days. 1 month, 2 months, and roughly 5 days. 45 days before the stock market peaked and rolled over. Remember, this is the S&P 500 here. The ratio of longs to shorts was in a battle. It was in a consolidation. It was a base here. How does that compare to the last 45 days for the same ratio? This is a 45-day box. This is a 45-day box. You can see in the present day, the ratio is making higher highs and higher lows. This is a clear uptrend for longs relative to shorts. So this ratio in the present day, as of the close on October 5th, looks quite a bit healthier than the 45 days leading up to this peak in May of 2012. How do the indicators look? Williams percent R. This is where you want to short or get out. This is one of those skinny peaks, and then it falls. Present day doesn't look anything like that. This looks good. This looks like conviction. This looks similar to this. Here, Williams percent R coming down in the short run. We did have a weak close on Friday. It's possible we have some give back, but these charts also seem to point towards higher highs after any corrective activity. Correction could last 1 day, 3 days, 3 weeks, but it's probably not going to last 3 months, at least in terms of probabilities with what we're looking at here today. Peaking process, the short-term trend in RSI. This is RSI for the ratio of longs to shorts, weak. Present day, RSI for the ratio looks healthy. Now let's scroll down, look at some of the other indicators. Do the same over here. Get this lined up. MACD. This is your peaking process where you want to get out of the S&P 500. MACD is rolling over. Here we go from a high to a low. Here we go from a low to a high. This is the close on October 5th. Obviously, this looks better than this. MACD histogram, peaking process. We go from a high to a low. In the present day, we're going from a low to a high. Notice histogram here is making the highest high that it's made on a short-term chart going all the way back to roughly, let's call it September 15th. So obviously, this is a bullish look here on the right side. Going back to the peaking process, rate of change started to roll over before the market rolled over, and then it accelerated to the downside from a high to a low. The present day, we're going from a low to a high. The chart on this side looks much better than the chart on this side, telling us that as of the close on October 5th, there are no major red flags. There are some yellow flags. This looks weak going into the close. This looks weak. But nothing that says we're near a major top here. When you're using technical analysis, sometimes you have to think, under the most bullish conditions, what might I want to buy? And in the present day, I think the answer is silver. If they're able to inflate, I probably want to own silver. As you know, we sold our silver at a nice profit, but I'd say the odds are very high that we'll own silver again. I still like it. In a deflationary scenario, if the market rolls over and they're not able to inflate, and let's say Spain had to restructure their debt, I'd probably want to own something deflationary like treasury bonds. So a good way to look at the battle between the deflationary forces in Spain and Italy, and really in the United States, because we're have way too much debt as well, and the inflationary forces of money printing from central banks, is to look at a ratio like silver divided by long-term treasuries. When this ratio is falling, deflationary forces are ruling the day and winning out over inflationary forces. When the ratio is rising, as it is here in the present day on the right side, the fear of future inflation or deflationary fears are decreasing. So again, we're looking at the same thing here. This is the peaking process. This is the S&P 500 on a 2-hour chart. This is where you would have wanted to get out, buy treasuries, or short. This is the ratio, silver divided by treasuries on a 2-hour basis. In the peaking process last year, treasuries were much stronger than silver, and the deflationary forces were clearly running out front relative to the fear of future inflation. The present day looks almost like the mirror image or polar opposite. This is a clear downtrend and deflationary. As of the close on October 5th, we're still in a clear uptrend. Notice we do have a lower high here and a hiccup. If you look at the ratio here, though, it appears that we're trying to break out. This is what once was resistance. Looks like it's trying to act as support above the arrow here. Let's just look at momentum. Williams percent R, when things weren't going well. The stock market is peaking here in a peaking process, and then it rolls over. You can see we've got a lot of skinny spikes here. There's not a lot of conviction for owning silver relative to treasuries here. Compare, this is a month, 1 month, and a few days. Compare the same period, a month, and a few days. Look at the conviction here, the bullish conviction of owning silver relative to owning a deflationary asset such as treasuries. RSI. We've bounded what this looks like in an orange box. Here, RSI never clears 70, and it actually does break below 30. If I put the same box over here, you can see we clear 70 here several times and never break below 30 here. This looks much more bullish with much more conviction looking back 65 days than this look back 65 days does, where the stock market rolled over. If we scroll down, emphasize here, we're looking at indicators based on the ratio of silver divided by treasury bonds. Look at MACD leading up to the peaking process. The S&P 500 rolls over here. Look how weak MACD was for the ratio. Compare it for the same period here. This looks much better. A lot of white down here, a lot of black in this box. MACD histogram, this is the highest high you've had in a while. We come down here, doesn't look too good. Here, short term, you see improvement. Rate of change, if we compare these head to head, Here, your rate of change, this is looking at roughly from 0 to 5. A lot of rate of change below the blue box. In the present day, we're in the blue box in terms of percentages a lot more here than we are here. Like the other charts that we've looked at, this ratio chart appears to show fears of future inflation on this side, and this is fear of deflation, fear of bond defaults. This is fear of money printing, open-ended QE, bond buying in Europe. Same exact concepts here. In this case, we're looking at risk on divided by risk off, S&P 500 relative to the VIX. When the ratio is rising, stocks are where you want to be relative to the VIX. When it's falling, you'd like to own the VIX here and not own stocks. S&P 500, this is where it peaks. So what we don't want to see, we don't want the present day to look like this period here after May 1st. Here, when the stock market was peaking and then it rolled over, the ratio of risk on to risk off was making a clear series of lower lows. Compare that to the present day, we're making higher lows, which is bullish. The conviction behind owning stocks relative to the VIX, extremely weak here before the S&P 500 rolled over. The present day, the conviction to own stocks relative to the VIX is very good. That's healthy looking. That doesn't look like a skinny spike. RSI, you can see we're making, this is a downtrend here, and we've actually broken an uptrend. So here's an uptrend in RSI that was broken for the ratio. So this is RSI for this ratio in early May, and then stocks rolled over. Let's compare that to the present day. It's just the opposite. We just broke out of this here in a bullish manner, downward sloping trend, upward sloping trend. Let's look at the rest of the indicators. Scroll down here a little bit. MACD, from a high to a low as the stock market rolled over. Present day, a low to a high. Histogram, lower highs. Here, the trend is up, and you've just made a higher high in MACD histogram for the ratio of the S&P 500 relative to the VIX. Rate of change, bearish, rolling over, high to a low, stock market rolled over. Present day, low to a high. Like the other charts, this chart, compared to the peaking process, the present day looks healthy. Same concept, same time frame, S&P 500. This is a 60-minute version versus a 60-minute version. This is where the S&P 500 rolled over. We don't want our present day indicators to look like this period here or even the period leading up to it. This is risk on relative to risk off, S&P 500 relative to treasuries. Line is rising, stocks are in favor relative to bonds. When the ratio is falling, bonds are in favor relative to stocks. You can see here prior to the peak, this is where you would want to sell stocks, buy bonds, or short. You can see the ratio. This is a lower high, and I'm making a series of lower lows. The present day, last thing we've done is made a higher high, and this is a higher low. This looks like a downtrend prior to the peak. This looks like an uptrend still. This is a little bit of a yellow flag here, no question. This is the stock market in the present day. This is a bearish divergence, so heading into next week, we do have to keep an open mind about a pullback. Until these charts look like this, though, we shouldn't be too concerned. Let's look at Williams percent R. This is momentum of the ratio. Weak, skinny peak here, a skinny spike. Market rolls over. Present day. Doesn't look anything like that. That looks pretty good still. We need to see some deterioration here. RSI for the ratio. If you go back 44 days in this box, you can see we basically stayed in a box that went from, let's say, -8 on RSI never made it above 70 looking back 44 days. If we look back 44 days now, the conviction on the bullish end of the spectrum is much, much better than it was here during the peaking process. Now if we come down and look at the balance of the indicators, MACD, similar situation. Looking backwards before the peak, never made it into the green box between 0.1 and 0.2. Here we did stay in the orange box a lot. If we compare that, looking backwards recently, and we're comparing apples to apples here because these are the same ratios. MACD looks much, much better. Never made it in the green box. Here we're in the green box. The amount of time that we're spending in the orange box, this is much worse here. We stay in it. Here we break out of it. Here we break out of it. Histogram. Lower, high before the stock market rolled over. This is May 1st. Here, as of the close on October 5th, the ratio histogram just made a higher high relative to this high. This looks much more bullish than this. Rate of change, same situation. A lower high and a series of lower lows. That's a downtrend. Just the opposite. A higher low and a higher high. Like the other charts, this ratio chart tells us, at least for now, we really don't have anything more than yellow flags. There are no red flags like this yet. We have to keep an open mind. These charts could change. It just doesn't look like we're there just yet to get overly concerned. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.